Hello, it's Jeffrey Crispin from CPM Group. We were going to be meeting on the week of March 16th during our roadshow for NOAA Capital Markets in South Africa. Global events overtook that. I spent a week in a hotel in Cape Town. And what we're going to do today is to make that presentation to you by video. We have updated a few slides because the world has changed in the last 2 weeks. In addition to that, we see this as a way of preparing for our discussion with you. So after you've watched this, it's a long presentation covering the overall economic world as well as platinum group metals and gold. After you've seen this, if you want to have a conversation with us, NOAA will gladly arrange that with you. Let me make sure that the technology is working here. The themes today, the economic environment for precious metals. We have changed circumstances and we're in uncharted territory. It's very interesting because even before the coronavirus pandemic became as global a problem as it was, this was our view of where we were going in 2020. We'll talk about some of the things that were already worrying us about the state of the world as we go through, and how it's changed even further with the COVID-19 virus pandemic. Talk about platinum group metals. Our theme has been there's a reversal of fortune underway between platinum and palladium. Palladium has done very well, moving to record prices and staying high based on both fabrication demand being strong and investors buying a lot of material. Platinum has been flatlining along the bottom. We believe that that's going to change. The change may be delayed somewhat now because of the COVID-19 problems and the devastating effect that is having on the global economy, including auto production and sales around the world. But it will come over the long run. In gold, we've been talking about the stealth bull market in gold. Gold prices actually have already risen to the levels that we saw at their peak in 2011, early 2012. A lot of folks in the gold market don't see that. They keep saying, when is the gold price going to rise? But the reality is that since June of 2019, the gold price has slowly but steadily, actually perhaps not that slowly, it rose in July and August of 2019, it came back off, and the price is actually at those record ranges that we saw a few years ago. That has occurred in an environment where there's been very little physical demand for gold up until March of this year. I'll run through some numbers toward the end of the presentation when we get into gold. So our view is that the gold market, which has been demonstrated in March, is particularly tight. And when we see the return of physical gold investors, the price is likely to rise even more sharply than it has been. So let's talk about the economy. In early June, this was our take on the risks to the economy and their role in the world. And the green balls are good for gold, bad for the world. Red balls are bad for gold, good for the world. Orange balls are relatively neutral. And we've been seeing these bubbles get bigger and move more to the right, so that their likely impact on the global economy and gold have been increasing in our view as to what the impact would be, and they've become more problematic. But they had not risen in terms of probability of coming home to roost the next 6 months or 12 months as of last June. If you go forward to today, those bubbles are that much larger. They have moved aggressively up into the right-hand corner, so their impact is greater, and their probability of coming home to roost in the next 6 to 12 months is that much greater as well. There are also a lot of new bubbles that didn't exist last June, for example, COVID-19 and increased hostilities. Prior to March, CPM Group had been projecting slower real growth in 2020 and a deeper recession around 2023, 2025. We still expect a global recession back of severe proportions in 2023, 2025. But we are also now expecting a global recession in the first half of this year. And frankly, it's already occurring. The world and the major economies are in a recession as of March. January and February were good for the United States and Europe, bad for China. But as of March, pretty much the entire world is in a recession. That recession is going to continue and get extremely hostile in the second quarter. Estimates of the contraction of the US GDP are ranging from 5% to 25% contraction in the second quarter. Global contraction, looking at zero growth to negative 5% in the second quarter. It's going to be very nasty. The question is, how fast will we recover? And CPM Group's view is that we may start to see some recovery in the third quarter. It's very hard to say because no one really knows how this COVID virus is going to shake out. But that by the fourth quarter, you might start seeing much more aggressive recovery in the economy in Europe and the United States, catching up with China, which will probably start recovering sooner because they're behind the curve with the virus right now. We have not revised our long-term annual projections. That's actually on our schedule to do in the first week of April. So this chart does not reflect the idea that we will see a sharp V-shaped recession in 2020, coming out in 2021, 2022, followed by a renewed recession and global financial crisis, probably around 2023, 2025. We still expect that. We think it is just be coming from a weaker base with even bigger problems than we had anticipated 6 months ago, 3 months ago. Now, the COVID-19 changes circumstances, and we really don't know how it's going to shake out. No one really does. There are all sorts of estimates, and it's just too early to tell. In addition to that, it has come with an oil price war that the Saudis have launched against Russia. The Saudis and the Russians had been working to maintain low prices in order to squeeze other producers, including marginal U.S. producers, Venezuela, Nigeria, and Iran. And then the Saudis have turned on the Russians as of the first quarter of this year. That has caused oil prices to fall by more than half, and it has severe implications, negative implications for some parts of the economy, positive implications for other parts. And we have an extremely unpredictable U.S. government. Although perhaps there are some signs that it's becoming a little bit more predictable, it's really too early to tell. Real business activity has plummeted around the world. As you can see, all the barbershops in New York City are closed. Our view, as I said, is that recovery will come. We might actually see things bottoming out by May or June. We may see some tentative signs of economic recovery in the United States by the third quarter, and we think by the fourth quarter things will come better. There are several factors that we put behind that. One is that the virus may go into remission in the northern hemisphere, become much more problematic in the southern hemisphere, including South Africa, unfortunately. Even if the virus doesn't go into remission, medical treatments, at least for the symptoms, if not against the virus itself, probably will start to emerge by late May or June. And even if neither of those factors happen on the viral front, governments and businesses will learn to work together and work around the pandemic by June. So we think that you will see the worst of the recession in the second quarter, and we think that by October you may see some recovery. There are several reasons for that. One is the massive global monetary accommodation that has been put in place. There are also going to be fiscal stimuli that will be coming out, although we're always very cautious about that. We saw after 2008, 2009, a lot of fiscal stimulus programs that were announced that never actually became very much mobilized, especially in the United States and to some extent in Europe, You had promises of $1 trillion of fiscal stimuli, and 2-3 years down the road, you had maybe 20% of that actually deployed. In addition to that, a lot of the things that have been canceled in the first half of this year are being rescheduled for October and November. And you have a US election that's going to be extremely competitive in November. So the US government will do everything it can to show economic recovery by September and October. We think that for all of those reasons, you may see a stronger recovery in the fourth quarter of this year than one might otherwise expect. But let's be honest. There are a lot of things that aren't known, and there are a lot of things that are misdiagnosed. We've been hearing talk really all along. Observers keep saying the $13 to $15 trillion in bank deposits on which deposit holders were paying interest was going to cause enormous problems. This was before the most recent monetary stimulation, and that number is probably somewhere between 17 and 20 trillion dollars now. But those observers don't say how or why this would cause problems. And more importantly, they don't answer the question, why would anybody pay interest to hold deposits? I want to talk a little bit about this because it speaks volumes to analyzing the global economy, financial markets, and assets like gold. The answer to why someone would pay interest rates is very straightforward. A lot of banks and institutional investors got that money by selling to central banks corporate and sovereign debt that they did not want, that they did not like. They had junk on their portfolios. They were worried about it. The central banks took it off their hands and in exchange gave them money. What do you do with money? Well, money is chips these days on a computer. So you wind up putting it in a deposit. The banks, the central banks, take the bad loans off of the bank's books and give them money, and they charge them 25 or 50 basis points in exchange. If you look at the banks that are paying interest on their deposits right now, they are reporting record profits, or at least they were until February and March. So it's not necessarily a negative for them. In addition to that, they have all this money on deposit, which they can use as collateral for derivatives that are giving them guaranteed returns of 4, 5, 6% per annum. Thus, their profits at record levels, much higher record levels than previously. So we don't necessarily see negative interest rates as being something that's going to blow up in the face of the global financial market. In addition to that, the realm of negative interest rates, and they've now transferred to the United States as of last week, changes everything. You keep hearing in 2019 that we had an inverted yield curve in the United States, and every time that we had an inverted yield curve between World War II and 2008, it either coincided with a recession, or it preceded a recession by anything from 2 months to 2 years, or it came shortly after we were in a recession. And the key thing is, in 2008, negative interest rates only existed in economists' imaginations. We talk about it over drinks at conferences, but negative interest rates didn't really exist. People who look at the inverted yield curve and say, historically from World War II to 2008, this has always coincided with recessions, miss the point that the financial system and the monetary system that has emerged since 2009, 2011 is radically different from that which existed from World War II to 2008. And if you're relying on a model that is based on historical correlations prior to 2008, you may be missing important changes that have occurred in the monetary system. So what if the gloom and doom prior to COVID has been wrong? In the gold market, we've had various commentators who have been predicting the collapse of the global financial system since at least the 1970s, my entire career. They were saying that the massive deficit financing around the world, 12% compounded growth in debt for decades, unbound monetary policy, all of this had to lead to the collapse of the global financial system. In 1980, US federal debt was less than $1 trillion. And Ronald Reagan ran on the premise that that was unsustainable. It's now about $22 trillion. That may well be unsustainable. But after 40 years of the Cassandras of the world predicting the imminent decline and collapse of the financial system, there are any number of gold investors who over the last few years have said, well, maybe these guys have the wrong model. Maybe they don't know what they're talking about. Maybe they should have studied Money and Banking 101 in college, if not something else. And maybe the thousands of economists and bankers at the Fed, at other central banks, and throughout the global financial system know more about money and banking than the gold bugs who have been predicting the imminent decline. Even in the event of COVID-19, this may be a longer term factor to pay attention to. One little factor, we had seen a sharp increase in federal deficits in the United States and the rest of the world during the 2007, 2008, 2009 financial crisis. It was a spike up, and then we worked it down from $1.4 trillion to about $460 billion, which is still obscenely high, but it was a fraction of what we had seen during the Great Recession and the global financial crisis. We have now stepped back up to more than $1 trillion in deficit, annual deficits, and rising debt. And that's before everything that's going to happen in response to COVID-19. So the Congressional Budget Office, which makes these projections based on existing laws and regulations that have been passed, and is a nonpartisan group, has been saying this time is different. We have trillions of dollars of annual deficits in the US government, and this is going to explode because of COVID-19. And these are structural. They're not going away quickly the way they did after the previous financial crisis. And that is going to bear significant negative consequences for economic growth in the long run and currency market instability in the long run. So there are problems out there, and I don't want to belittle those problems, but the reality is that the problems may not be what the gold bugs say, and the problems may not be what other commentators are saying. The political problems may not be the US political dysfunction. It may not be Brexit and the future of Europe. What it may be is that there are bigger underlying issues: surplus labor, surplus commercial real estate, surplus retail capacity, the rise of nationalism and tribalism globally, the discrediting of democratic processes and non-oligarchic free markets worldwide, and the breakdown of international cooperation and US hegemony, at least with the US. All of those factors are probably much more important in terms of creating a long-term environment which is hostile for economic growth and positive for gold investments. Now I'm going to turn to platinum. I'll come back to gold at the end. Platinum prices, as I said at the outset, have been flatlining really since 2015. They fell sharply after the big strike in South Africa in the first half of 2014, and they haven't really recovered. Our view has been and continues to be that the price of platinum will continue to recover. You can see it's a modest recovery. We have it struggling to get back to $1,000 an ounce by the middle of next year, but we do think it will start to rise. And in the long run, we think there's going to be a period of sharply higher platinum prices, at least for a time. And this goes back to that whole reversal of fortune factor. A lot of people in the platinum market have their supply and demand data wrong, and they're expecting a much sharper decline in fabrication demand than is likely to occur, And they're not necessarily factoring in the idea that you could have another round of 10% or 15% reductions in South African mine production in the long run. The reality is that alternative energy vehicles, new energy vehicles, electric vehicles, or anything else, are decades away. You have projections that people are basing their investment decisions on that by 2030, 10 years from now, you might see a third of the cars being produced and sold in the world electric vehicles. That can't happen. There's not enough electricity. There's not enough stable electrical distribution grids. And there's not enough capacity to build the motors and the controllers and everything else that goes into those vehicles. Our expectation is that you might have about 10% of the vehicles being battery powered by 2030, and a growth in hybrid vehicles. And the hybrid vehicles continue to use gasoline or diesel, and they continue to use platinum group metals to clean up things. We expect that platinum demand will hold up much better than a lot of people seem to be thinking, because gasoline and diesel, petroleum-based fuels, are not going away anytime soon. They will go away, perhaps, in the long run, and what they're replaced by is up for conjecture and a lot of hypotheses, and we'll talk a little bit about that later. But the reality is that for the next decade, you're going to continue to see strong demand for platinum group metals in auto catalysts. And yes, you are seeing, and you will continue to see, a substitution away from palladium back toward platinum. The engineering on the undercarriages, on the manifold, on the placement of the catalyst, on the fuel injection system, a lot of that engineering is in place now. And you see a lot of automakers pivoting back to the three-way catalytic converters that were the norm from the time the US started using catalysts in model years 1974, which were built in 1973, up until really the mid-90s. Our view is that the platinum market has been in large surplus for a long period of time. It continues to be in large surpluses and will continue to be this year and next year and possibly into 2022. But as time goes on, we think that mine production doesn't keep pace with fabrication demand as the auto industry shifts back to platinum from palladium, and that by the time you get into 2025 or so, you will see a sharp, a large deficit developing in the platinum market, which will continue for some time. And that is the basis for this price projection that I showed you earlier. We have the price relatively flat for the next several years, but then as those deficits emerge, we think platinum prices will rise, both because of higher fabrication demand and because investors will wake up to the realities of automotive propulsion technology. In the world, there's a lot of platinum above ground stocks. And you can tell from this one that a lot of that platinum, perhaps half of it, is owned by investors. We have estimated investor holdings, which we feel quite comfortable with, partly because a lot of that platinum was bought by investors that we advised in the period from 2000 to 2012 and continue to advise. And a lot of it was bought in an earlier period by people that we knew. Investors actually sold platinum last year, and a lot of the platinum that went into inventories was actually going into the industry's inventories. Platinum supply through 2019 is actually down a little bit. South African production fell only slightly last year, and it was outpaced in its decline by secondary recovery and production cutbacks elsewhere. Secondary supply fell sharply, partly because the vehicles that are being recovered now are vehicles that were made at a time when people were shifting away from platinum to palladium catalysts. So you have palladium intense catalysts as opposed to platinum intense catalysts coming off the road. You also had some technical problems at the refineries that were processing this scrap, which caused a reduction in platinum refining last year. Fabrication demand has basically been flat. You can see the automotive growth has been rising about 1% a year. That's largely reflecting large commercial vehicles, trucks and buses around the world, which continue to use diesel and continue to use a lot of platinum, even though there is some substitution away from that. In the passenger vehicle market, or including trucks, SUVs, small trucks, SUVs, and passenger cars, the two big diesel markets continue to see a decline in market cap. And about 30% of the vehicles in India now are diesel, down from a peak around 45, and around 35% of the vehicles in Europe are now diesel vehicles, down from a peak around 54% a few years earlier. Going back to these alternative auto technologies, fuel cells, and I'll go through that a little bit more, they are being commercialized. The market acceptance and penetration is unknown at this point. There are a lot of financial as well as technical and logistical issues related to using fuel cells. In theory, it's positive for platinum fabrication demand, but a lot of research has been going into technologies that either reduce the amount of platinum being used or substitute the platinum with manganese or other metals. As I said earlier, electric vehicles, we think they will have a marginal impact on PGM demand over the next 10 years. Ultimately, they may be a transition technology to some future motive propulsion system, or they may be the future motive propulsion system of choice. It's too early to tell, but that transition is going to be much slower than a lot of people think because of those logistical issues I mentioned earlier. Lack of electricity to power these things, lack of stable grids to distribute that power, and the need for tens of billions of dollars of factories to build the componentry in a world where the smaller private or public equipment manufacturers that supply those components to the auto industry are strained for raising capital either through the debt or the equity markets. So petroleum powered vehicles remain dominant and are probably going to remain dominant for decades to come. Our view, and this goes out to 2050, our view is that by 2050, you still have a significant amount of vehicles, perhaps 35 to 50% of the vehicles, burning petroleum, either as hybrid vehicles or diesel vehicles or petroleum powered vehicles. So you still have a very large portion of the vehicle market being using gasoline and using three-way catalysts to clean the exhaust. You can see that by 2030, we have a relatively small market share going into battery electric vehicles and a relatively small market share going into hybrid vehicles. Hybrid vehicles are taking the lead right now because they offer the technology that the auto industries feel they need to offer their consumers, who are still concerned about charging battery-powered electric vehicles. But we think that ultimately battery-powered vehicles beyond 2030 start taking the lead over hybrid vehicles. And then jewelry demand, still high. It has fallen over the last few years. It's primarily a Chinese phenomenon at this point, and it probably will continue to be relatively strong, but not a big growth area. Investors have added to their platinum ETF holdings over the last year or so, and those are now at record levels. But a lot of the platinum that has gone into them is offset by platinum being sold by investors who are not ETF investors, who are holding physical platinum and who have been selling the metal off. And then my last one before I go into fuel cells is where we have seen a lot of platinum interest is in the futures and options market. And there you have seen over the last year or so record long positions in the futures market. So a lot of shorter term investors in platinum, as in gold and silver, are actually trading and investing in PGM, platinum, through the futures market as opposed to the physical market or the mining equities. Fuel cells. I'll just go very quickly here because I've already talked about it. They're very expensive. They have a very high maintenance issue. There is a scare at C-level executives about using them in fleets because all of a sudden you have compressed hydrogen in a tank on your parking lot at your warehouse, and you need to keep that cool even in the face of a power outage in your place, which means you have to have a very expensive power backup system at your warehouse. So we saw several large wholesalers and retailers moving toward fuel cell powered forklifts at their factory, at their warehouses, and now they've started to back away from that. Not so much because of their concern, but because of the concern of their insurance companies. We still are relatively skeptic on this. I think there's a lot of misrepresentation, which I've already talked about. These are the projections that the platinum industry has made going back to 1980, when the platinum industry in South Africa was saying that by 1988, 350,000 ounces of platinum would be used in fuel cell vehicles. And the most recent number here is from 2019, which was 350,000 ounces a year could be used in fuel cell vehicles by 2030. The platinum industry has always had too high of expectations as to how much platinum is going to be used in fuel cells. And from a long-term perspective, this is what ought to really be of concern to platinum producers and investors in platinum mining companies. The platinum industry is pushing liquid organic hydrogen carriers because they think that that will speed the use of fuel cell vehicles, and it will speed the use of platinum in fuel cell vehicles. But the auto industry says, given my choice, if you can give me safe and affordably distributed hydrogen through liquid organic hydrogen carriers or any other technology, if you can get hydrogen safely shipped, stored, and distributed to users, I would rather probably have an ICE hydrogen engine than I would a fuel cell. There are a lot of technical issues related to the ICE hydrogen engines, primarily the fact that the hydrogen causes the metal in the vehicle, in the engine, to become extremely brittle. So you have to use higher quality steels in your engine. That's one of the big issues. But if you look at it, it costs about $3,000 to build a gasoline or diesel internal combustion engine. A battery pack right now, depending on the size of the vehicle, could be anywhere from $8,000 to $10,000. A fuel cell could be $30,000 for a fuel cell stack. And a hydrogen engine, which has fewer moving parts than a petroleum-based ICE, costs about $1,500. So a lot of auto executives say, if you can give me hydrogen at the pump in a cheap and safe way, I would rather build vehicles with hydrogen engines than fuel cells. And that's a long-term issue. It's not coming along anytime soon, but it's a real issue. Turning to palladium, in contrast, record prices and sustained record prices, and much, much higher prices. Our expectation is that the price might peak. This projection actually came out before the recent round of COVID virus inspired declines in auto production and sales. Our expectation had been that the price would sort of peak in the first quarter of this year and come off and move sideways at a high level over the next couple of years. We still expect that. And then longer term, we think that the palladium price comes down for a variety of reasons, one of which, big one, is the substitution away from palladium back toward platinum. It's not 100% away from palladium to platinum. It's more toward a catalyst that might use twice as much platinum as it does palladium. It used to be the norm in trimetallic three-way catalysts. The palladium market was in a big surplus 20 years ago. That surplus largely disappeared about 8 years ago. The market has been relatively finely balanced in terms of newly refined supply from mine production and scrap versus fabrication demand. You have recession risks, you have substitution risks. Our expectation is that after a couple more years, you're going to start seeing larger surpluses in palladium because of that substitution risk. And because a lot of the palladium still comes from Russia, which produces about almost as much as South Africa. And the Russians have the capacity to produce a tremendous amount of palladium. Fabrication demand has been much more vibrant because of the substitution away from platinum into palladium, because of the substitution away from diesel into gasoline. That probably is going to peak over the next few years. Investors have been selling their palladium. They pretty much got rid of a lot of it, most of it, and that sales pace has diminished. You also saw perhaps 700,000 or 800,000 ounces of palladium sold in the physical market away from the ETFs in 2019. And the platinum palladium ratio suggests if you can, you should use platinum. Rhodium is another one. It has gone parabolic. It's done that several times before. This chart only goes back to 1992, and I apologize for that because if you look at 1980-81, it went sharply higher. If you look at 1988 to 92, it went sharply higher, and each time it came back off. This time, we're not convinced that it will come back off because we think that the rhodium market is much tighter. And while there's a lot of platinum and palladium lying around in refined form, we don't think that there's a lot of rhodium. So we do see the price coming off. These are quarterly average prices. If you just look at the price of rhodium in the course of March, the price peaked at $12,000 in early March. It dropped to $5,500 a couple weeks ago, and it's back up around $10,000 as we speak. But the bid-ask spread is about $3,000 to $5,000. So the rhodium market is extremely illiquid and extremely volatile. Our expectation is that the price does stabilize at record high levels. And then on a longer term basis, we do expect it to come off because there are technological alternatives that are being worked on now. They may take several years to emerge, but we do think that they will emerge over the course of the coming decade. This could lead to rhodium surpluses and could help put the price cap on those prices. Rhodium supply, relatively flat over the last few years. Rhodium demand has been rising sharply and steadily and probably will reach a plateau. And there's one ETF or two ETFs that are out there, and we've seen a slow diminution of that. I want to turn my attention to gold. And this chart only goes back to 2010, but we can see that we reached record levels again 2011, 2012. And those record levels were $1,550 up to $1,900. And starting in December and January of this year, we got back up into those levels. See that the price pretty much moved sideways from 2014 to 2019, even into the first half of 2019. If you look at this chart, you can see a lot of people have been talking about how gold prices rose sharply in the second half of last year. But if you look at this chart and you study it more closely, you can see gold prices rose sharply in July and August. They peaked September 5th, 2019, and then they came down until late December. Then they started rising, and now they've risen into these record levels. Gold prices, as I said at the outset, rose last year without strong investor buying of physical metal. It traditionally is physical gold investment that has driven the price higher and lower. But what we saw last year in July and August was a lot of buying in the futures and options markets, as well as forwards and ETFs. Shorter term momentum driven investors while the longer term macroeconomically driven investors who traditionally buy physical gold had stayed out of the market until March. March of this year has changed that. We did see some physical ETF demand. A lot of it seemed to be coming from momentum traders. And interestingly, if you look at the changes in ETF holdings, the changes in futures and options, gross long and net long positions, and the price movements, what you see is that much of the ETF demand seemed to come from shorter term investors, and that the upward price moves were more coordinated with the futures and options buyings and not the ETFs. The ETF buying tended to follow the price increase, whereas the futures and options buying tended to coincide with the price increase in July and August, and then again since that time. Coins and bars, meanwhile, have been extremely low. Our view is that the price is going to be very volatile. We would not be surprised to see the price spike up to $1,800 at any point. The fact that tomorrow is the first delivery day of the COMEX options April contract probably means that maybe that won't be now. But we think, given the state of the world economy, the idea of a spike up to $1,800 in the second quarter cannot and should not be ruled out. And it is the coronavirus, it's the economic consequences of the coronavirus and the government reactions to it. It's also the oil war between Russia and the Saudis, which is not going to end anytime soon. And it's other issues such as the US assassination of the Iranian Republican Guard General Qasem Soleimani in January, which started off the year. Gold investment demand in 2018 and 2019 was the lowest levels since 2001. That said, we have gone through a period of a upward shift in the investment demand curve. You had more investors in more parts of the world buying more gold for a longer period of time at higher prices between 2002 and 2012 than at any point in time prior to that in history, even World War II. The fact that the gold price has been rising in the absence of strong physical demand for gold suggests much higher prices when and as those investors come back. And as I said, we started to see them come back this year. These are our projections of that balance going out 10 years. You can see that 2023, 2024, 5, 6, we have investment demand rising 20, 30, 35 million ounces a year. Our expectation is that the economic and political and financial environment will be hostile enough at some point, and we're pegging that at 2023, 2025, to drive investors back into gold at the levels that they were buyers from 2002 to 2012. I was giving an interview last week to someone, and at the end of the interview, I said, in November 2000, CPM Group issued a buy recommendation on gold. And we said at the time, the gold price was $270 an ounce, and it had been below $300 from 1997 through 2000. And we said in November of 2000 that we thought that the global economic and political environment and the financial market stability or instability over the next, not years, but decades, would be so great that it would cause an upward shift in the investment demand curve for gold. Investors would want more gold for a longer period of time, and that we would see gold prices spike much higher than the $850 peak that we had seen in 1980. Because we thought that for a period of decades, not years, the economic and political environment would be much more hostile than it was in 1978, 79, 80. After I said that, the reporter asked me, would you say the same thing in 2020? And my answer was yes. It may not be quite as bad, but the ingredients for a continued extension of a period of extremely hostile economic and political problems with severe financial market consequences is probably greater today than it was in 2000. So we think that this gold renaissance in terms of investment demand will resume and will continue. We actually have it lasting only 4 years in the mid-20s and then coming off, but that can easily change as it changed over the course of the period from 2000 to 2012. As a consequence, we have the gold price at the second highest level in annual average terms this year. We're now projecting about 1640 for an annual average price. The price was about 1579 in the period up through March 23rd of this year. The peak nominal gold price annual average was in 2012. It was 1670. We're around 1644 that we're projecting for 2020. So the second highest level. It's that stealth bull market. And then we have it moving sideways for a couple of years before rising much more sharply to record levels in the mid part of this decade. Central banks have stepped into the void that was created by investors pulling back in 2018, 2019. They have been buying more gold than they had at any period of time prior to, since the dissolution of the Bretton Woods dollar gold system, where they would buy gold as a way of settling their international trade and capital accounts among governments. They are more sensitive, price sensitive than in private investors. And you can see in the lower right-hand corner, when the price rose, they bought less. When the price fell, they bought more. And now in the last couple of years, they've been buying more even though the price is starting to rise. And that reflects that dissolution of international cooperation and the loss of hegemonic powers of the United States. The dollar, meanwhile, remains king. Gold as a percentage of total central bank reserves, about 10%, largely unchanged for the last 20 years. The US dollar, about 60-62%, largely unchanged over the last 20-25 years. We did see that increase in that period, 1995 to 1999, but you have to understand that was when we were moving toward the euro. So people were selling their European currencies, which would become redundant as of January 1st, 1999, and they were putting their assets into the dollar. Central banks were doing that. And then after the euro was created, the data for the euro on this chart prior to 1999 is a composite of those currencies that went into the euro. After the euro was created, you started to see central banks move money back into that at the expense of the dollar, but the dollar is still around 60-62%, which is sort of where it's been. In the bottom right-hand corner, I want to point something out. That's a composition of global monetary reserves at central banks. And you can see this enormous increase from 2000 to 2012. And it's kind of plateaued. It came off a little bit and now it's gone back up. But look at the gold part at the bottom. That is the gold, the value of the gold at market value held by central banks. Because a lot of people complain, well, central banks are fools because they sold off 130 million ounces of gold from 1980 through 2008. But the reality is they also freed the gold price. It had been fixed at $35 an ounce in 1968. They floated it and it rose sharply. So that the dollar value of their gold actually is far greater than it was back in the 70s than it is today. Not by virtue of the fact that they've added gold, they actually sold gold on a net basis over that period of time, but because the value of that gold has risen. So the dollar remains king among central banks for monetary reserve purposes. They'd love to move away from it, but there are all sorts of constraints because the liquidity of other currencies and gold is so small relative to the liquidity of the gold market. It would be extremely hyperinflationary if there was a major move out of dollars into euros, yens, pounds, Swiss francs, any other currency, or gold. And it's not just central banks. About 75% of private wealth is denominated in dollars on a global basis. Gold supplies, this is my last chart. We do have them falling. Not as much as some believe, because a lot of people look at the mine production. And if you look at the mine production, which is gold here, you can see we actually have it falling sharply over the next several years. But we believe that secondary recovery will rise, partly because we think the price is going to rise, and partly because we think people will be selling their gold jewelry because of financial stringencies, the way they did in that period 2007 to 2012. So we think that total supply of physical gold will decline, perhaps not as much as one would think if you only looked at mine production. That's my presentation today. I'm sorry I didn't get to give it to you in person, but as I said, we're looking to see how we can change the way we relate with you. Take a look at this thing. If you have questions or comments and you want to discuss things, Noah will gladly put together a conference call or a video conference with you going forward. And hopefully by August, when my next roadshow is scheduled, all of this will be behind us, and I'll see you in Johannesburg or Cape Town. Thank you and have a good day.